I think we're about to start in 10 seconds or so. Hi, everyone.
Hello, and welcome to Vite's webinar. We are going to do today's webinar. We will focus on EU ETS. Are we talking about decarbonization industry or deindustrialization in Europe? And today to present I'm joined by Marcus Ferdinand, Vite's Chief Analytical Officer, and Harry Öhman, our Senior Analyst in the EU Carbon team. So today we will first start the presentation where we look at the current status of the market situation. Then we're moving into cap trajectory up until 2030 and also beyond up until 2040. And then how the lower cap and the phase out of free allocations due to CBAM impacts European industrial sectors. And then we will dive even more into industry. First, a bird's eye view on the status of European industry before we start with a sectoral deep dive into the steel sector. Presentation will end with the market balance and price forecast before we round off with a Q&A session towards the end of the session. If you want to ask questions, you use the Q&A panel, and hopefully we'll be able to answer quite a lot of the questions towards the end of the session. Then, so who is Vite? We all representing Vite. It's a company looking at carbon and renewable energy analytics. And please contact us after the presentation if you want to know more about our offerings on carbon markets, guarantees of origin, PPA markets, and other low carbon markets. So, but today it's carbon, and of course, kind of good timing. Yesterday, European Commission President Ursula von der Leyen presented the competitive compass. So that's the economic doctrine for the next 5 years. So kind of steering kind of what the new Commission is working with the competitiveness as the key word. This translates the recommendation of the Draghi report into a roadmap. And it's a joint roadmap for decarbonization and competitiveness. On the 26th of February, the Commission is expected to present the Clean Industrial Deal. It's one of the action points under the competitive compass. And that is setting out a competitiveness-driven approach to the decarbonization of industry. So it's very much kind of going from focus from just the green, now it's kind of green and industrial. Yeah. And here it's a kind of just a glimpse of what you can expect from our carbon offerings on the portal. We do kind of in-depth analysis on the sectors covered by the EU ETS, both short and long-term drivers, price developments, policy, follow the policy process. But then I guess we can kind of start now. Marcus Ferdinand will take us through kind of the market, current market status. So Marcus, please.
Thanks a lot, Ingrid, for the presentation start and kind of providing a lot of context, which I think we will touch up on over the next 45 minutes or so. We thought we'd start with a brief recap on where the EU ETS price stands, just to get everyone on board to understand where the drivers are currently. And that's obviously super important when you talk in the context of industrial decarbonization. As you can see on the left chart, which depicts the front December contract, The European carbon market has seen several ups and downs during the past year, with a significant bullish move since late last year and like dragging on obviously now, which we can touch up on in a second as well. What's the main drivers here? So the adoption of a tighter policy framework pushed the market to an all-time high in February 2023. And then as a reaction to the Russian invasion of Ukraine, the EU launched the Repower EU program, which front loads allowance auctions from later years to the period 2023 to 26, which then caused some bearish pressure as more supply than anticipated is coming to market, and at the same time, gas prices decline. So when gas prices decline, well, many of you know it, it's cheaper to produce power with gas-fired generation instead of coal, which emits less emissions and per generated megawatt hour of electricity, and hence also decreases demand for UAs. That caused steady price drop, leading basically to prices around 52 euros per ton in March 2024. Before then, rebounding gas prices basically lifted the UA contract towards the 60 to 70 euro range again. And in November last year, it became clear that the European Commission would not adjust Repower EU volumes, something that many had anticipated, given the low average UA price last year, which then supported prices lately, together with bullish gas prices as a result of the cold winter and lower storage levels, as well as the stop of the transit agreement of Russian gas flowing through the Ukraine. So since mid-December, EUA prices have increased by almost 30%. That was caused by the break of several technical levels, coupled with investment funds actually turning net long. And that pushed the price towards and above the 80 euro per ton levels again in January, with the DEC 25 contract closing at 82.95 euros per ton yesterday. And I think this morning we have already seen prices above 84 euros per ton. Investment funds extended the net length by another 11.2 million tons last week, now reaching 53 million tons, which is the highest net length since September 2021. And while lengths were building, also short positions increased by 3.6 million tons, which probably got burned a bit by last week's price move. If you look on the right side, the bar charts, the average price of an allowance in the EU ETS in 2024 was 67 euros per ton, 22% less than in 2023. But interestingly enough, the traded volume with 11.8 billion allowances changing hands during last year was much higher compared to the previous year. So altogether, despite the rather low average price last year, the traded value of the market was down just 0.3%. So far, year to date, the EUA DEC 25 price averages at 75.6 euros per ton. But as this webinar is about industrial abatement pathways, I'll cut the price discussion short here. Obviously, our analysts publish a lot of in-depth content and data on our platform regarding the current market situation. So yeah, in case you're interested to have a more detailed discussion around current price drivers, just reach out to Ingrid or myself after the webinar. Moving to industry. So for industry sectors, we expect 591.5 million tons of emissions in 2024, which is 0.2 million tons lower than previous year, more or less unchanged, which is interesting in itself, given the heap of negative news on macroeconomic conditions and layoffs that we've seen over the past year. The neutral development comes mainly from a minor rebound in some of the EU's materials producers, comparing production. So the left chart for the first 3 quarters in 2024 to 2023 shows that metals, one of the biggest industry segments, was up 2.2% from 2023, mainly due to higher steel output. So domestic steel deliveries have dropped, mainly because of lower demand from Europe's automotive sector, but higher exports have offset this. So that contributed to the overall uptick. Yeah, and then pulp and paper up 3%, oil and gas up 1%. So other segments such as chemicals continue to contract, but less so than in 2022, as we'll see in Harry's part of the presentation. In comparison to pre-COVID levels, so 2019, all sectors remain significantly lower, with chemicals taking the biggest hit with minus 22%, followed by minus 15% for iron and steel. Yeah, so while industrial confidence indicators remain largely negative, we expect 2025 industry emissions at 586.6 million tons, which is 0.8% lower compared to our 2024 estimate. That was a very brief recap of current drivers and industry data points. Let's talk about the paradigm shift that needs to happen to balance the EU ETS going forward, and the big question whether European decarbonization is possible without a significant reduction in industrial production. We'll focus now on the role of industrial market participants in the EU ETS and their ability to maneuver and also to clear the market. Beyond 2030, as you all know, allowances will dry out. The cap is actually going down to zero by around 2040. And what you see here is basically the cap trajectory in bars as projected based on current legislation for the EU ETS in comparison to an emission trajectory, which in this case reflects an IEA assessment of policy measures announced. I mean, we have a different price forecast here, but to illustrate this, I think this picture becomes quite clear. There will be residual emissions in the system, as some industrial processes can't technically reduce emissions to zero. That's the main important takeaway from the slide. So there is a gap to be closed to abide basically by the cap, while not deindustrializing Europe. There is different options that you can take. Massive investments are obviously required in industry abatement over the next few years, which is the focus point for this presentation. But we can also talk about other measures like linkage to other systems. I mean, most prominently, we've just seen an approach by the EU and the UK to basically re-inject life into that discussion. Can talk about that probably during the Q&A session. Another option is to allow for negative emissions to be accounted for in the EU ETS, so domestic removals, which is the point that was also raised by yesterday's Competitiveness Compass presentation, or to potentially integrate on global scale via robust Article 6, allowing for the import of high quality credits. So we can have lots of discussions around all of those points, but we'll focus on the role of industrial abatement now with regards to solving this equation with the presentation today. When we move on, we basically have a look at the relative importance of industry emissions as part of the ETS, and the bar chart shows the growing dominance of industry emissions as part of the ETS coverage. Industry is taking over the majority of emissions, although on a smaller absolute number of emissions, which requires a shift of focus from power sector abatement to industry abatement in order to solve this market. Also then with the gradual phase out of free allocation from 2026 to 2034 as part of CBAM introduction, industry sectors will have to face the full carbon cost of their activities. Pressure is therefore on industry to abate, and with it the need for business cases to justify the required investments into abatement technology as a function of, amongst other variables, the carbon price. When we zoom in on the latest available verified emissions data from 2023 on the next slide, it's the first time that industry has passed 50% of relative emissions in comparison to the power sector and transport sectors. Largest sectors here are steel, oil and gas, and cement and chemicals. And this will continue as we've just seen on the previous slide. So my colleague Harry Ullman will now walk us through a deep dive on industry data and the abatement costs and potentials before I'll meet you then again to conclude on how we see the market balance developing and what it means for UA prices. And obviously for the Q&A for, as Ingrid mentioned, for which you can already submit your questions in the chat. Over to you, Harry.
Thank you. We can just stay on the previous one for just one second. I just like to make one quick point. Thank you so much. So I just make a quick recap here. What is EU industry, and then we'll talk a little bit about the state of the industry and the kind of cause of its current problems and how that relates to carbon, and then go on to this sector deep dives. So the only point I want to make here, and I think I made it before, and it might not come to news as anyone, is just what we're talking about when we're talking about EU industry, because I think in the sort of public debate, when you talk about EU industry, you talk about something that's rather with a rather different focus. Here in terms of EU ETS, when we talk about industry, we're talking about steel, oil and gas, cement, chemicals, basically basic industry, right? So it's EU industry in terms of EU ETS is more a company like ThyssenKrupp than it is Volkswagen, even though the latter is 10 times the former in terms of revenue. The former is 10 times the latter in terms of emissions. That's the only thing to have in mind. So What we'll do on the next slide is that we will, if we can move to, is to look at kind of what's happened to these basic material producers over a bit of a longer time span. And it's clear if you look at the first of these two graphs here that they peaked in terms of production just before the Great Recession, so 2007, and it has been sort of in some sort of secular decline ever since. And you can see at the end to the right here that they're kind of at 70 or 60% of total production they were in 2007. And I guess our point here is that we don't think this is mainly due to carbon. It's a trend that we see in many advanced economies. To illustrate this, I put US steel production at the bottom graph here, and that peaked even earlier. So the graph there is indexed at 1974 to, so it's 100 at 1974 when they peaked for steel production. And it's at so it's 48% of that today, or in 2024. I mean, the reasons for this we shouldn't get too far into it, but I mean, one hypothesis is that you just build less roads and bridges. And that's where most of the steel goes into: roads, bridges, and houses. And after a while in a developed economy, you become saturated with that type of infrastructure. So you build less and less of it every year, and you need less and less of steel and cement every year. The other reason, I guess, is that there's a tendency in advanced economies to as you become more and more productive, to move away to sectors that are more lucrative financially speaking, such as maybe advanced manufacturing or even services. So it's a sort of an maybe not natural, but at least something quite unrelated to carbon. It should also be noted that during this period, all of these sectors receive very generous amount of free allowances in the EU ETS system, while the price was also very, very low for most of the period. In the slide after this, we want to look at kind of zoom in a little bit to the current situation. So this is a version of the slide that Marcus showed earlier, the one on the left here, where we're looking at industrial production compared to the previous 2 years, and then also to pre-pandemic levels. And we see that even though we've seen a slight rebound this current year, for the reasons that Marcus talked about, we're still down compared to pre-pandemic levels. And it should be noted that those levels were even lower than, of course, as we saw on the previous slide, that's what it was in 2007. But what's the reason behind the recent decline here? And we think that this is not because of carbon, either. We think this is rather because of lack of demand from downstream sectors, so typically the automotive sectors or the construction sectors. They're struggling because of the sluggish economy and high interest rates and so on. And to illustrate this, we put this graph on the right, which shows consumption of steel in the EU. And if you look at the apparent consumption, which is what is bought by producers within the EU, so it's down 13% since pre-pandemic levels, and which kind of corresponds quite nicely to where we are in terms of the production as well. So it seems like that's mirrored quite perfectly. In fact, it's actually true that exports of steel has gone up during this period. So in the last couple of years, so it sort of, if exports had gone down, you might think it was due to competitiveness or something like that. But if that's not the case, you think there's probably something else that's at the heart of it, and we think that's just the struggling economy. But of course, you could think that, well, the downstream sectors like automotive manufacturing, they are struggling because of high carbon costs. But in the next slide here, we don't think that's the case. essentially because carbon cost is such a low share of the downstream sector's cost. So we have calculated how much do sectors pay for carbon, and what share is that of their overall production costs. And on the left, we show upstream and covered sectors, which are, I mean, roughly speaking, are the sectors where most of the carbon cost is the actual cost that they pay for EUAs. And here we've taken steel, cement, and aluminium. And as you can see here, it's quite a significant share of cost, especially in cement. But you should also note that a lot of this is covered by free allocations today. But if we then move to the downstream sectors, whereas here is represented by automotive manufacturers, that only translates into about 1% of their costs. This is assuming that they would be paying that the upstream sectors would pass down 100% of the carbon costs, not including free allocations to the downstream sectors. So it's a very small share of an manufacturer's costs overall. So we think there's other problems going on there. So this kind of concludes the section about the current problems of the industry. And I mean, in essence, we think that neither the long-term secular trend nor the recent downturn of the industry is because of high carbon prices. And this kind of means that we don't think that carbon market reforms will solve these problems. Obviously, it should get away and shouldn't get in the way of solving these problems, but it's not the cause of it. But in the next section, we will look a little bit more what's happened with decarbonization, because that's what we're really hoping to happen rather than the deindustrialization. So here's just a graph where we've shown both production and emissions across these four segments: steel, and cement, oil and gas, and chemicals. And what we can see is that they're still strongly linked. There's still a high correlation between emissions and production, and lots of the abatement that we've seen to date has been due to reduction in production rather than actual decarbonization or a shift in the production methods. But in the last couple of years, we've seen a little bit of a decoupling between production and emission, especially in cement, but also a little bit in steel and oil, and you can see a little bit in oil and gas as well. We think this is due to energy efficiency measures and some other marginal improvements in production. We haven't yet seen any large-scale decarbonization projects come to fruition. But going forward, and this is what I'd like to look at a little bit more in the section on steel, which is our next section. So in this section, we'll just look a little bit on steel, how it's produced today, and what are the routes that are chosen by the EU producers. So currently in the EU, steel is produced primarily using one of two routes. So either we have the primary steel produced mainly in blast furnaces, or we have secondary recycled steel produced in electric arc furnaces. And it's, as you can see, it's about 50-50 between these two routes. Electric arc furnaces has very few emissions associated with them, but due to a lack of scrap steel, which is the main input, and some quality issues with the output, it's not feasible to replace all primary steel with recycled steel. So essentially all the emissions comes from the blast furnaces. And then there's currently one plant in the EU using this direct reduced iron route with natural gas. Which is that route is interesting because it's essentially you can say a relative of the DRI with hydrogen, which is the preferred clean route of EU producers. So the clean production routes, there are of course many more versions of this available, but somewhat stylized here, we've chosen two. So you can see here we've counted the number of active commercial scale projects in the EU that's attempting to deploy various production routes. And what we can see is that essentially all of them are doing some version of DRI with hydrogen. Essentially what you do when you do that is that you're replacing coal as a reducing agent to remove the oxygen from the iron ore with green hydrogen. The other route sometimes talked about here is blast furnace with CCS to capture the emissions from a blast furnace, and there are some pilot projects that have been going on, and there's some sort of cancel and stall projects, but essentially no large commercial scale projects. And then what we'll move on to do is to kind of lift the hood a little bit on our industry model. So here just to give you a sense of how we are modeling and how we are thinking about what the price of carbon might be going forward. So here we have taken all these different production routes, and we have modeled what production costs could be using these different routes by essentially taking different business cases based on a variety of sources and then updating them with current commodity prices. We can see from this one that both of the green routes are significantly more expensive than the green alternatives. Currently, the cheapest route is DRI with hydrogen, which might not be unexpected given most of the producers are aiming for that route. It should, however, be noted that in this picture here, we've used a quite low hydrogen price of 3.5 euros per kilogram, and that price is probably best seen as a long term, what you can best hope for in a quite long term outlook. And it's not what we see coming out of any current production facilities. However, the DRI with hydrogen has another benefit, and that's that many producers think that they can then go via the DRI with gas route, so they switch to that first. Then they hold out there until either the EUA price becomes high enough or hydrogen price becomes low enough before switching completely to clean. So in the next slide, in the final one of my section, we kind of just put a little finer point on this, and we had just calculated the marginal abatement cost here from the data that we had previous slide, and also added the emissions intensities. So what we've done is we've taken the emissions intensities of each, compared it with the blast furnace route, done the same for production cost, and then we divide one by the other to get a marginal abatement cost shown on this page. We can see here that both the green routes require quite a significant EUA price, so not that much higher than we've seen to date, but we need to prices needs to keep steady as well. And it should also be noted that those prices that we see there requires quite low hydrogen prices that we haven't seen to date. But we've also seen that some might choose to go to this DRI route, which actually has in this particular analysis where with this particular commodity prices has a negative abatement cost because the emissions intensities of producing steel with DRI and natural gas is lower than doing it with a blast furnace. So essentially what we are saying is that we need quite high carbon prices to incentivize the investments needed to close the gap between the current emissions trajectory where we need to be to reach the targets and the cap laid out in the EU policy. And with that, I think I'll hand over to Marcus again to conclude this webinar.
Yeah, thanks a lot, Harry, for those insights. So question is, what does all of that mean for the market balance and then also for our UA price forecast? If we look at the balance in the first place, and I think you have to probably forward twice here. So this is basically our view on the market balance with regards to the cumulative market balance as a blue line, and then the annual market balance as the bars. When we look at the bars, which is basically depicting how long or short the market is in any given year, you can see that in 2025, the market is almost balanced on annual level. So we expect a long 9 million tons market in 25. But then we're moving into a very, very short period during the years 2026 to 2028. We expect that the year 2027 is going to be the shortest year ahead ahead of the end of phase 4, with a 235 million ton shortage. This is because the cap trajectory sets quite an ambitious tone here. We are basically kind of seeing the effect of REPowerEU volumes stopping. So there is a very tight market balance ahead. So the transition from a power-dominated to an industry-dominated system is extremely crucial here to understand when it comes to solving this market balance in terms of determining the UA price. So in this case, industry abatement costs and also industry investment behavior is key to solve the market. We all know that the market stability reserve in its current state is only a very short-term relief, but doesn't really come to the rescue when the market turns shorter and shorter, because the allowances in the MSR are limited. So in order to solve the market, industry abatement will be the price setter. And I mean, Harry just had a deeper look into the steel sector. We obviously have done this for other sectors as well. So this is in a way the backbone when we talk about our view on market prices and where the market is going. In addition, there's obviously a discussion going on right now on allowing for negative emissions to enter the system. And we think that negative emissions are required to basically keep European industry alive in Europe beyond 2030 within the EU ETS, in order to balance for the residual emissions that we expect, which are obviously higher than the cap at a certain point in time. So when we look into prices, we expect market participants to realize this prospect of a large annual shortage in 2027, starting from next year, basically. And we also see a very high chance that there is a mimicking effect of the bull run, which we have seen ahead of the start of the market stability reserve in 2019. So the market is preempting the shortage, which will basically hit the market balance as of next year. So we do foresee a paradigm shift to the cost of emitting that already happens starting from this year. And I mean, we are seeing a new price paradigm unfolding as we speak. We believe that European carbon prices are set for a significant increase during the next years, seeing a step change in our forecast from 28 onwards, when we see the MSR stopping to withdraw allowances. So our updated forecast sees prices at 92 euros per ton on average for 2025, with a gradual build up over this year, but ending the year above 100 euros per ton. And we do see prices, as a result of what we have outlined before, climbing year on year to reach 195 euros per ton in 2030. So with power sector emissions dropping sharply over the remainder of this decade and beyond, the industry sectors in Europe have the key in their hands to ensure that the decreasing cap is respected and that the market gets balanced. So this is why we are focusing more and more on kind of a very deep dive and a very deep drill into industrial abatement costs, even more than we did in like the years before now. So for the remainder of this decade, annual balances are in negative territory. as I've shown on the previous slide, with the peak shortage, as I said, in 2027. Repower EU volumes are still put on the market in 26. We do see 58 million tons coming to market unless there is any adjustments required to fit with the 20 billion euro revenue target. And the MSR is working with up to 1.5 year time lag, which will then respond to low emissions and added auction supply. So basically, worries about high energy prices, energy autonomy, industrial decline have become the main drivers now of Europe's energy policy. Political focus has shifted from green to clean industrial. All eyes are on the clean industrial deal that the Commission is due to unveil on the 26th of February. But the EU ETS, as we've heard yesterday during the Competitiveness Compass presentation, is certainly here to stay. Ambition level will remain very much unchanged because the Commission has reiterated its focus on the 2040 target and the climate ambition that it has made before. With that, I would end the presentation part. Yeah, as you can see, Ingrid and I will also be at eWorld in mid-February. Happy to discuss much more in detail any of your additional problems and areas of interest that you want to bring to the table while we're in Essen. But let's probably use the next 5 to 8 minutes or so for Q&A based on the questions that you had, like seeing the slides, and I hand over to Ingrid for moderating that session. And you will have to unmute, Ingrid.
Sorry, again and again. Thank you, Harry and Marcus, for the presentations. We have some questions, a bit short and longer term things. Maybe we can start out with the compass that was announced yesterday or presented by Ursula von der Leyen yesterday. So does the competitiveness compass have implications for the EU ETS? I don't know, Marcus or
maybe I can take it. So I mean I alluded a little bit on it already, but well, I mean Ursula von der Leyen I think was very firm that the EU will stay on course when it comes to target setting. But she signaled room for flexibility on how to get there. So it's a bit like, yes, we maintain ambition, but we in a way have a look at the pathway towards that. I think during the Q&A session with the press, she also praised the ETS as a perfect system, which one can debate what a perfect system is. But at least I think she made a point that it's market driven, it's technology neutral, and it's in a way the best way that Europe has to reduce emissions. So I think the Commission also clear during yesterday's presentation wants to reward first movers. So I think this doesn't sound that there will be massive changes to the ambition level of the system itself, right? So von der Leyen was very clear in her message that the European Union stays on course for the Green Deal objectives without any questions. So a lot of like those statements were made. I think what is a bit interesting is like this was clear messaging. Then at the same time, in late 2024, the Commission hinted that there would be a legislative proposal coming on the climate law, which was scheduled to appear in late February, so the 2040 target basically, alongside the Industry Clean Deal. But latest indication now suggests that it probably doesn't come before Q2, maybe Q3. So there is a bit of like, let's say, mixed feelings here, while the main ambition level, I think, is quite clear. I think what is important to mention here from yesterday's presentation is that CBAM has been singled out as a candidate for simplification under the competitiveness guidelines. So the CBAM review intended for this year will be quite an interesting one, I would say. There will be discussions on extension of scope, further sectors included, downstream products, framework conditions for exported goods. I mean, we can probably talk a bit more about this as well. But I think there is like CBAM is one of the candidates which might see some change as a result of it. And I think another very important topic mentioned in the communication was references made to incentives for negative emissions. So tying incentives for the up and coming ETS directive revision, which is planned for 2026, to build a business case for permanent carbon removals, which read a bit stronger in terms of wording than previous communication by the Commission on the role that the EU ETS could play as an incentive for removals. So, yeah, well, summarizing, I think yesterday's presentation was a bit like strengthening the Northern Star of like a green low carbon transition, but devil lies in the details when it comes to the simplification of measures and the way how this then basically hits legislation.
Thank you. We have another question here, which is goes to Marcus again. Can you repeat what you see with negative emissions CDR if and when integrated in the ETS?
Yeah, well, I didn't even say when it's going to be integrated in the ETS and if. I think it's one of the most important questions I think that policymakers have to answer when it comes to solving this market going into the post-2030 period. I mean, we've seen kind of several initiatives lately, also on legislative side, to make this kind of a more prominent topic. And as I said, during yesterday's communication on the competitiveness compass, it was explicitly mentioned as one of the areas to look at. I think we all agree when looking at the market balance that it will be extremely tough to clear the market balance without some form of negative emissions flowing into the EU ETS. How the incentive mechanisms for negative emissions as part of the ETS will be designed remains kind of, I would say, up to the 26 ETS directive review, where I think we'll get quite a few more answers on how the Commission plans to do this. So with that kind of said, I can't give a definite answer because we're a neutral analyst. We're watching obviously what's happening, and then we'll adjust our modeling accordingly.
Thank you. It's quite a lot of questions coming in here now. So let me pick one. Let's see there. How do you see the impact of overlapping policy subsidies on marginal abatement cost and your price forecast? Harry, do you have any kind of thoughts around that?
Well, it's something that we try to include in our model. It was not included in the slides that I showed now, and there were raw costs. Typically, for industrial installations, what subsidies mean is that they get some capex support, meaning that part of the building and construction of the factories are being supported. That helps, but I think for many of the materials that is included in the ETS, it's a lot about what the commodities actually cost and how efficiently you can produce them. So it only goes so far, and we try to incorporate it the best we can. But obviously, the biggest subsidy is the ETS, of course, which also is a kind of subsidy.
Thanks. And then on CBAM, because we have, I mean, lately it has been both kind of news on EPP want to kind of postpone CBAM. It's a French, I don't know, France will organize a big kind of CBAM discussion way kind of improving CBAM or kind of, yeah. What is our view on CBAM? CBAM, could it be delayed?
Well, I can start. I think this probably deserves a separate webinar, to be honest. Yeah, I mean, you mentioned a few points here, right? I mean, there's a CBAM review scheduled for this year. So there's a few parallel tracks which are unfolding. One is to simplify the CBAM architecture, which, as I mentioned, was part of the presentation yesterday as well. So especially towards smaller emitters. There is a discussion on extension of scope to further sectors, downstream products, framework conditions for exported goods, and then also, as you just mentioned, on the EPP side, there was some voices asking for a delay. On the simplification or simplifying the architecture part, So it's one of the more obvious measures, I think, to take. It's really low risk, I think, also for policymakers to go down that route. I think there was also signals from the Commission on a different place that around 65% of the importers covers less than 0.1% of the total emissions, right? So willingness, again, to simplify the system. So we think this might be done even ahead of this year's scheduled CBAM review process as like a separate legislative process. On the extension of scope, as you mentioned, there is a high-level conference scheduled for 12th of February in Paris to discuss the next step for EU CBAM. It's a bit like, I mean, basically it's bringing together policymakers, member states, other stakeholders to, like, in a way, form the first step towards framing policy discussions ahead of the 25 CBAM review, which is due end of this year. France was quite vocal, suggesting priorities for the reform, including kind of the integration of downstream sectors, maintaining a free allocation for exported CBAM products, some strengthening measures against circumvention of the border levy, right? So I think the extension of indirect cost compensation for energy-intensive industries might also be on the agenda, and as currently planned, the 25 CBAM review would not include carbon leakage through exports. So bringing this forward to 2025 might appease a political environment that has a bit like shifted attention from climate to industrial competitiveness, and could be in a way an interesting kind of compromise arising here. On the delay, the third point, as you said, EPP leaders retreat, that was mid-January. There was a release, or like a statement released after that, amongst a lot of other things. It said CBAM should be put on hold for 2 years. So EPP basically leaders suggested during this time the regulation should be reformulated to only apply to larger companies. So quite a few of the points that I mentioned earlier, which probably will be taken up anyway. Delay message was a bit backtracked afterwards. A few influential and like EPP members not really supporting this in full, but nevertheless it's out there. And then we saw quite some interesting statements from industry associations providing full support of CBAM, urging policymakers to strengthen the policy as soon as possible. I mean, also obviously simplifying it where needed and possible, but in a way, don't backtrack was a clear message, right? And I think this is a bit what was echoed yesterday as well. Let's keep ambition levels high. Let's find ways to get there a bit easier in a way. But let's not punish the front movers. And I think this is quite important message as well to those who have taken some of the investments. I think we can talk long about this, but CBAM is obviously a very important kind of discussion point here when it comes to kind of to easing let's put that way, to transpose the kind of ambition burden on industrial sectors in the kind of least disruptive way.
Thanks, Marcus. We have one on what's your view of the impact of new Trump administration on EU ETS prices, but I guess we can kind of talk about how that potentially can impact the European industry first, at least. Harry, do you want to give it a go?
Well, I guess a lot of these upstream sectors. I mean, we import very little steel and cement and oil and gas to Europe, so that's not the problem. But I guess it can be a problem for the automotive manufacturing, for example, because Volkswagen sells all cars to the US, and if the US becomes closed for business for Europe, then that will be a problem for that will sort of simmer out through European industry. So I guess that's sort of the indirect impact it might have on the EU industry.
Yeah, I mean, maybe just to add a few thoughts here, and obviously not talk about the small issues today. I mean, there is uncertainty in the market, right? Also uncertainty with regards to future investment decisions. And I think this is again why the Commission went out yesterday with very strong statements on keeping ambition levels high on the climate side. I mean, trade war, obviously a challenge, could lead to increased inflation, prolonged macroeconomic downturn, despite the recent signs of recovery. So could be bullish gas prices, bearish industry production. So maybe dampening effect on EUAs. But I think that said, the EU has been very firm on its climate targets. It's reiterated the direction. So I think the impact on the EU ETS could be somewhat on price levels, but I don't think on price direction compared to what we've shown in our modeling. So there is 3 years of extreme market tightness ahead. This market tightness will not go away, no matter what the kind of reaction will be, right? Because the reaction will not be to significantly change the EU ETS kind of architecture.
Thanks. I guess this was kind of the big questions and the bigger questions. But I guess I mean, we have answered quite a lot of the questions now, and I think maybe we can round off this session now. There have been some questions around if the presentation will be available. Those that have signed up will get the link to the webinar recording in the next few days. So I guess thank you, Harry and Marcus, for your insights, and thank you all for participating and joining our webinar today.
Thanks, everyone. Speak soon. Bye.
Bye.